Vamos a continuar con la última sesión, la segunda sesión del seminario de introducción a la investigación en los temas estos de los mercados financieros. Y hoy tenemos el placer de contar aquí con Johannes Muhle-Karbe, de la Universidad de Viena, recientemente incorporado al grupo de investigación del profesor Segermayer que tuvimos ayer aquí. Es doctor por la Universidad de Múnich y bueno, pues es gracias a la beca esta, al contrato este de Bruselas que tienen allí en Viena, pues él está ahora de postdoc. Entonces nos va a hablar. Bueno, pues esta es la presentación continuando con lo de ayer, y nada, agradecer que ha venido. Thank you very much for being here. It's a pity that you cannot speak Spanish, but it's the same because everybody here can understand you. So don't worry and go ahead.
Yeah, thank you, Pepe. Pleasure to be here and give this talk. And let me first apologize that I can't give it in Spanish, but with my knowledge it would be a very short talk. So yeah, I'd rather do it in English. So let me first say that this is joint work with Jan Kalsen from Kiel, also in Germany. And as Jose already said, I'm going to talk about using shadow prices and portfolio optimization with transaction costs. So since I guess most of you have never heard of all this stuff, I will start by explaining what I mean with that. So the first section with which I'm going to begin, this is going to be the basic problem that we want to deal with. So as it is stated in the title, this is this portfolio optimization problem, which is also often called the Merton problem, because Robert Merton was the first one who could solve it in a continuous time setting. So first of all, just this portfolio optimization problem, no transaction costs, very basic. Afterwards, I'm going to tell you what changes if you introduce these transaction costs that Walter was also talking about yesterday, because this fundamentally changes the problem, makes it much more difficult. Yeah, and this is really what I want to deal with. So far, no new results, just the problem that we want to deal with. Afterwards, I'm going to introduce the approach that I want to use to tackle these problems. And this is where these shadow prices come in that I alluded to in the title. And here I'm going to explain what this concept is and how we want to use it to tackle this problem here. So far, this is really conceptual. I want to try to convince you that this is an interesting idea, an interesting approach to tackle problems like this, and this is going to be light on the mathematical side. And then afterwards, I want to show you really mathematically how to use this approach to tackle problems like this. And this is going to involve some mathematics, so I hope to give you a little bit of an idea what kind of stuff we're doing here, how we're tackling such problems. But maybe some of it is not so easy to understand if you've never seen this before. So if you have any questions or you're totally confused, please just interrupt me and I'll try to explain again just so that you can follow along. Okay. So let's start with the first part. The basic setting that we want to use for this portfolio optimization problem. Well, first of all, we want to have a look at what kind of investment opportunities the investor has. So here we have some investor who has some money at his disposal and who wants to invest either in a bond or in a stock. So the same basic model that Walter was using yesterday. And again, we make things as easy as possible and just assume that this bond doesn't grow, it's just normalized to 1. The stock, we model again as a stochastic process. So here we have two parts. So the first part is this drift part, and the second part is a diffusion part, which is driven by such a Brownian motion. So if we just draw a little picture. Which is exactly the same one that you've seen during most of the talks these days. Then here you have some part which is somehow smooth in time. So if you look at this and you graph it, this one is differentiable, this one is smooth. And this one here, this comes from Brownian motion. This is not smooth. This is something that wiggles around like this. So if you take these two together, you have one part that somehow models the trend, the drift of your process, and you have another part that gives you these random fluctuations, how it wiggles above and below. Okay, so this is the basic model that we want to use. And now we look at an investor who's putting his money either in these bonds or in these stocks. So the trading strategies of this investor are modeled by these two quantities. So we have one number that counts how many bonds I have, and we have one number that counts the number of stocks. So this phi 0, just to remember, this is the number of bonds, and this phi here, this is the number of stocks. And in addition to that, this is really an investor who needs some money to finance his life. So at every time point t, he chooses a consumption rate, how much money to consume from his bank account. And later on, he'll try to choose a strategy which allows him to take out as much money as possible, to consume as much money as possible, in order to make the investor as happy as he possibly can be. Now, of course, everything here would be completely trivial if we can just consume as much as we want without having to pay for it. So somehow we must introduce a notion of self-financing strategies, so no money comes in from the outside. We just have some money in the beginning, then we invest, and the gains we make, these we can consume, but there's no new money coming in from the outside. And this is captured by this equation here. So if we're looking in some little interval at the increments that we have on the bank account, so this is how much this number of bonds, the money we have on the bank account, how much this changes in a little interval, then the first thing is obvious. If we consume something, it goes away from our bank account. So if we go onto the cash machine, we take money out, this is deducted from our balance sheet. And now the other thing that we have to take into account is if we're using the money on our bank account to buy stocks, or if we're selling stocks and we get the money on the bank account. So if we're changing the number of stocks that we have, this is this other quantity here, and say we are buying some stocks, so we make this money larger, so this increment is positive, then we have to pay the price ST at that time, and the price times the quantity is deducted from the bank account. And the other way around, if we're selling some stocks, this is negative, and we get some money on the bank account. So this is this very basic notion that whenever we consume, we lose some money. Whenever we're buying stocks, we lose some money. When we sell stocks, we get some money. But there's nothing coming in from the outside. We just start with some money, and then everything evolves according to this equation. And again, we need one more quantity really to set up our framework here. And this is this notion of admissibility. Because if I can just say, okay, I have a bank account, but I can just take out as much money as I want with no limit, then I can just consume as much as I want, and there's really no solution to any problem here. So we introduce this condition here where we say, okay, we look at how much money we have on the bank account. We look how many stocks we have and multiply by the current price. So this is how much money we are holding in stocks. And this total amount of money we have must be positive at all times. So we start with some amount of money, and then we consume, we buy and we sell stocks, but we can never go below zero. So if we go bankrupt, then everything's over and we can't consume anymore. So this is really the very basic setup. Now the optimization problem that we want to look at here is the following. This is to maximize expected utility from consumption. So let me explain this step by step. So as I said before, we choose this admissible strategy where we're just buying and selling stocks, and at every point of time we decide how much we want to consume. And this consumption, this little ct at time t, this is now plugged into such a utility function. So here we consume, say, 3 euros, and this function will tell us how happy this makes us. And so these utility functions, they usually assume to look something like this. So you say that if I increase my consumption, so if I can spend more money, that makes me happier. So the more money I have, the larger this should be. So this is usually assumed to be increasing. And if I have very little money and you give me $1 extra, then this will make me a lot happier. So this should be very steep when I have very little money. But if I already have $1 million and you give me $1 extra, yeah, this will not change much. So this is why this usually becomes flatter and flatter. And for example, the logarithm is one function like that. And this is actually the one where the computations are the easiest. And this is why they take this one. So this is not because we think this is really the right function, but just for the computations, this is the best. OK. And now we don't want to look just at a single point of time, but at all times and points from today until all infinity. And the time preferences of the agents, this is modeled by this impatience rate delta here. So if I can consume €1 today, I prefer this to consuming €1 tomorrow. So I'd rather consume now than wait for a long time. And so if I consume the same amount somewhere in the future, this is discounted by the rate delta. And then I sum this up from today until infinity, and I take the expected value, and I try to make this as large as possible. So this is really the basic problem that we want to deal with. And this was studied in this continuous time setting already by Merton in 1971. So is everybody OK with this problem? OK. So now that we've really stated this is the problem we want to tackle now, let's have a look at what the solution looks like. OK. So what do we have? So we have to figure out two things. One of them is how much to consume. And the other thing is to decide how much money we want to put in the stock and how much money we want to put on the bank account. And now it turns out, this is very nice about this logarithmic utility function, that the consumption, this is always known explicitly. So we take a look at how much money we have in total. So this is the money we have on the bank account, the money we have in stocks. And of this, we consume just a constant fraction. So for example, every day or every year, you take 10% from your total wealth, and this you consume. The rest you invest. Then next year, you take out 10% again. And if you like consumption now more than later, so if this delta is large, then you can consume a lot. And if you don't like that as much, then you don't consume as much. And so now, the strategy, the investment strategy, that looks a little bit similar. So here the thing, that is described most easily is this fraction. So this fraction of wealth that we put into stocks. So here we have the number of stocks times the price of the stocks. So this is how much money I have in stocks. And this here is how much money I have in total. So this is the part of my money, of my total money that I have invested into stocks. And so this thing is completely determined by this drift coefficient here and the diffusion coefficient. So if the stock, on average, grows very fast, and this drift coefficient is large, then I put a lot of money into stocks. Makes sense. If the stocks grow very fast, I invest a lot of money into them. And on the other hand, if this fluctuates a lot, so if this is not like this, but fluctuates a lot more, then the sigma is larger, and then I invest less into the stock. So this is really a risk-averse investor. If I have more risk coming from these fluctuations, then I put less money in the stocks. And now for the Black-Scholes model, really the classic model that we've seen a lot during the talks here. Both of these things here are constant. So this is just a constant. This is just a constant. And then this fraction here is a constant as well. So then you have your model parameters, which tell you, for example, I want to invest 30% in the stock at all times. So this is then also, this is constant. This is also constant. OK. So as I said before, if we look at the Black-Scholes model, we'll always keep, for example, 30% in the stocks. But now what happens is, if the stock prices move, then this fraction changes. So if the stock price moves up, this becomes larger, and this stays the same. So in total, the fraction will be higher. And so now I have too much stock, but I only want 30%, but now I have, say, 31%, so I have to sell some stocks. And the other way around, if the stock prices go down, then I don't have enough stock anymore, and I have to buy some stocks. And now, because this Brownian motion, this never stays constant, this always goes up and down, I have to trade all the time. So whenever this moves, I have to buy or sell, and so this means I end up buying or selling all the time. And this is okay in this model, but now you can imagine that if we add a little bit of transaction costs, so every time I buy or sell, I have to pay a little bit extra, this is not possible anymore, because now I'm buying and selling all the time, so really I'm making infinite transactions, and if I have to pay a little bit for that, I go bankrupt immediately. So in a way, this strategy is completely unreasonable if we add just a little bit of transaction costs. Without transaction costs, it's the best strategy. With transaction costs, kills all my money immediately. So there one has to do something different. And yeah, one really has to come up with a different strategy. So this is what I want to talk about now. First, how to set up this model for transaction costs, how to introduce this, how to set up the optimization problem. And then I have a look at what the optimal strategy looks like here. Okay. So we keep the bond the same, just 1, constant, normalized to 1. We keep the stock the same. This is still such a process here. And later on, we'll only look at the Black-Scholes model. So you can just forget about these little t's. Just think of some constants. So now, here come the transaction costs. This is really what makes the model different. Which means that now if I want to buy stocks, I cannot do this at this price, capital T, ST. But I have to pay some transaction costs, which are proportional to the amount of I'm buying. So for every stock, I don't pay ST, but I pay ST plus lambda times ST. So these are the transaction costs that I'm paying. And the other way around, if I'm selling stocks, I don't get ST, but I also have to pay these proportional transaction costs, mu times ST. So in the end, what I have is no longer this price process that's evolving here, but I have one higher price. This is the one I can buy for, and I have a lower price. This is the one I can sell for. And even if this is small, I'm always a little worse off than if I could trade at the price in the middle. Now the self-financing condition is a little bit different. So again, we look at how the amount of money I have on the bank account, how this changes. So the last term, this is the same. If I consume, I have to pay for this from the bank account. But now if I buy or sell stocks, the price at which I can do this depends on whether I'm buying, then I have to use this higher price, or whether I'm selling, then I have to use this lower price. So these little arrows here, these denote that if I make the number of stocks smaller, this is the down arrow, then I only get the smaller price. But if I want to buy, then I have to pay the high price. And both transactions, this is always taken care of on the bank account. So again, no money coming in from the outside. But just whenever I trade, I get the terms that make me worse off. So you can see immediately that if at the same time I want to buy or sell, then all my money gets burned, because when I buy the stocks, I have to pay the high price. When I sell them, I only get the low price. So I can burn all my money immediately if I want. And now this admissibility condition, this is also a little bit different. So again, we say, okay, the amount of money that I have, this should never be negative. So again, the bank account, this is just the money that I have. But now the number of stocks that I have, if this is positive, then I can only sell them for the low price. And if it is negative, and now I want to close my position, I want to liquidate my portfolio, then I have to buy them for the high price. So this is always, again, the negative scenario for me. Okay, so with these notions, we can then look again at the optimization problem. And you can see this is still exactly the same thing. We choose our consumption rate, look at the utility this gives us for every t, then we discount, integrate from now to infinity, and then look at the expected value. So this is completely unchanged. The only thing is new is this, that this admissible now means all the things that we had on the slide before. So we have this self-financing condition, we have this admissibility condition, both coming from these two prices here. But apart from that, everything's still the same. But where is the optimization problem? You can still write it down in the same way. If you want to solve this, this is much more difficult. And before, we could really do this here for arbitrary stochastic processes. Now, it will only work in the Black-Scholes model if both of these are constant. And even then, the solution will be much more complicated. Yeah, so I said this. So what does the solution look like? So just remember, again, the problem without transaction costs. This is what I was telling you before. Here, the consumption was just a fixed proportion of current wealth. So for example, every year I consume 10%. The amount of money I put into stocks was again a fixed fraction. So for example, these 31%. And both of these numbers you can compute from the model parameters. So if you know this alpha, you know the sigma, you know this discounting rate, then you know this number, you know this number, everything is known explicitly. So now if you do this with transaction costs, let's first say one word maybe what the strategy looks like. And this is really an insight that goes back to this paper of Margiel and Konstantinidis. So this is over 30 years ago. And they had the idea, okay, if I look here at time, and I look at the fraction that I'm holding in stocks, then if I don't have any transaction costs, the strategy that I would like to follow is to keep this constant, say at 31%. But now with transaction costs, I can't do this, because now this fluctuates, and I can't afford to keep it at the 31% all the time. But I would like to. So the further this gets away from the 31%, the worse it is for me. So at some point, it pays off to start buying or selling stocks. So it turns out that you get such a no-trade region, where as long as you're inside this region, you say, okay, it's not worth buying or selling stocks. But once I get to the boundary, I say, yeah, I really want to go back in the middle. So I have to do a little bit so that I just stay in this region. The same on the upper boundary. So I just do the minimal amount of trading I have to do to stay inside this interval. So for example, if the optimal fraction without transaction costs, if this would be 31%, this might be, say, 20 to 40%, depending on how large the transaction costs are. So as long as I'm here in the middle, I don't do anything. And when I hit the boundary, then I just do enough to stay inside. So this is the structure of the solution. And now, of course, the crucial question is, how can I compute these numbers? Because this one here, this was known explicitly. And now I want to know, how do I get these numbers? And this is what was done by Davis and Norman. They showed that, this consumption rate, this is some complicated function of everything else in the model, but this can be computed. And this corridor you can determine as the solution to a free boundary problem. Yeah, I'll explain what that is later on. But just think of it as something, this is about, you have to solve some differential equations, do some minimization. Yeah, I'll talk about this later. Can still be done, but it's much more complicated than here. Okay, so in principle, the solution is known, has been known for some time. Was a lot of hard work in these two papers to figure this out. And the methods that they used, this was stochastic control theory. So there you use partial differential equations to somehow come up with a solution. And what I want to do in the remainder of the talk is to present a different approach. So this doesn't use the stochastic control approach, but instead uses something different, which is more in the direction of the things that Walter was presenting yesterday. So just to emphasize this again, so the solution to this problem, this is well known, has been known for a long time. But here, we just want to introduce a completely different method. Okay. So this is now the next part. This is the shadow price part, where I want to present this idea that we want to use for the solution here. So here, we just have the same picture that I erased here a minute ago. So the price in the middle this is the real stock price. So this is your Black-Scholes model, how prices move up and down. But now it turns out with transaction costs, this real price doesn't matter at all, because we're never buying at this price, we're never selling at this price. Doesn't matter at all. The only thing that matters is the high price, because this is what we have to pay if we want to buy, and the low price, because this is what we get if we're selling. And now this is difficult, because with this transaction cost, the problem is hard. So it would be very nice if we could find some other price process, which we call shadow price, which somehow lies between these price processes and gives rise to the same problem. So the idea is as follows. So we have a problem with transaction costs, with this high price and the low price. And now we want to find such a price process in between, such that we can replace this problem with transaction costs with a problem without transaction costs. And the price that we'll have to pay is, while the price process in the middle is maybe very simple, the shadow price will be more complicated, but we get rid of the transaction costs. So this is really the idea. And of course, if this should be, maybe let's just go back one slide. If I have this price process in the middle, of course, this is much better for the investor, because at every point of time, if I want to sell stocks, I get more than with transaction costs, because this price is higher. And if I want to buy stocks, I have to pay less, because this is less than this upper price. So every price I can put in the middle is better than this transaction cost problem. And now I want to find one of these prices which is so horribly bad for the investor that is just as bad as this original problem. So this you can rephrase as such a min-max theorem. So the original problem is something like this. So at every point of time, I take the worst price that I can have. So if you decide I want to buy, I give you the high price. If you decide you want to sell, I give you the low price. So at every instant, you always get the worst price for you. And with this optimization problem, you try to pick the best strategy. So this is our original problem. And now this idea with the shadow price says, okay, we can change this. Now we fix one of these prices, and you take the best strategy, and we try to take one price, one fixed price that's somehow in between, where if you take the best strategy, you get the same result as in the original problem. So somehow we can switch the order of these two things. And this idea, for this to work, what we really need is that the shadow price is always at the boundary whenever the optimal strategy trades. So if we look at this picture, so if we have the optimal strategy with these transaction costs, and say at some point here we want to buy, then this price must be at this boundary, because otherwise we could buy cheaper and we would get more utility. And the same thing here, if we want to sell, then this price must be here, because otherwise we would be better off. And so now the question is, does this really work? So far this is just the idea, and it's not clear, does such a process exist? How to come up with it, that's another question, but even the existence, this is not clear at all. And for these arbitrage things, similar concept was discussed yesterday by Walter Schachermeier, and there we really have a nice theorem that tells us when these processes, which lie somehow in the middle, when these exist. But here things are not yet quite worked out, but we're working on this. So just a brief summary. So there are a few results by Karatzas and Cvitanic, also by Mark Löwenstein, where they look under models at models like this, and under quite restrictive conditions, they can show that this works. But this is still not very satisfying. And then what we did here with Jan was to look at the thing if our probability space is finite. So if we have a model which is very simple, so one of these tree models, say, where there's only a finite number of possibilities, how this can change, then it also always works. And in this case, this is really nothing fancy. Doesn't involve any stochastic calculus or something like that. This is just a finite dimensional optimization problem. You have some constraints because you have these self-financing conditions. You have admissibility conditions. So you solve this problem using Lagrange multipliers. Then you think about it a little bit. And these Lagrange multipliers, they give you this shadow price here. But in general, this is still open. And as I said, this is something that we're working on, having a look whether this really always works or whether it can fail. At the moment, it looks like, yeah, usually it will work, but in some crazy cases, it might go wrong. But as I said, this is still work in progress. Okay, and the same idea, this is not just used here. As I said before, Walter was using it for these arbitrage things yesterday. Has also used in other areas. But everywhere, this is really structural. So you want a statement, there exists such a process, but nobody tells you anything about how to find it. And so the aim for the rest of the talk is to show you a little bit in the very simplest problem. So if you look Black-Scholes, logarithmic utility, infinite horizon, you make the problem as easy as you possibly can. There we want to find this process and use it to solve this problem. And yeah, if we would somehow know this process, this would be very good. Why is that? Yeah, okay, if this was such a nice process, as we were looking at before, yeah, then I showed you how the solution looks like. So if we don't use the original price, but the shadow price is tilde, okay, then we just consume a constant fraction, as in the model without transaction costs. We just hold this fraction here, which is coming from the dynamics of the shadow price. We also know this. And the only thing that changes is that we compute in terms of this price as tilde instead of the original price. So if we would know this problem, if we would know this price, problem solved, we're done. But of course, the problem is we don't know it. And so if we want to use this idea for computations, then this is an unknown that we want to find. And this consumption rate and this fraction of stocks, this is also an unknown. And so somehow we must determine all these things at once. So this is the idea, and this is what I want to explain in the rest of my talk. Okay, so any questions at this point? Or is the general idea somehow clear? Okay, so either you're all lost or it went very well. Okay, so let me try and give you an idea how we come up with this shadow price. So again, remember our stock price. We take the very simplest model that we can. Take the Black-Scholes model, constant drift rate, constant diffusion rate. Then we have this bid price. This is the price at which we can sell. This is this lower price. And we have the ask price. This is the higher price. So if I just draw this picture again. We have the higher price and the lower price. And now we want to find this shadow price, which is somewhere in the middle between these two. And so now it's just a matter of writing it in a way which is most convenient for the computations. And it turns out that this is a good way to do it. So we say, okay, in this shadow price, this is the original price times a factor like this, which measures how far we are away. And so, of course, if this should be in this interval, then this thing, this process C, must also be in some transformed interval. And so now the question is, if we want to make an ansatz, we want to guess what this shadow price looks like, we somehow need a process CT that only moves inside such a bounded interval. And so yeah, we have to think a little bit about how we can achieve this, because if you look at Brownian motion, say, then this doesn't happen. I mean, Brownian motion, you start it here, and if you look at some path, it will become very large. If you look at another path, maybe it becomes very, very small. And with Brownian motion, you can never achieve it, that somehow it stays inside such an interval. So yeah, really you need to do something different. And yeah, what can you do? So for example, if you have Brownian motion, and yeah, let's not look at an interval, but just at the half line. Let's just say we want to make this stay positive. yeah, what can we do? And maybe the simplest idea of what we could do is say, okay, we don't take Brownian motion, but we take the absolute value. And now this is certainly positive. I mean, when it hits this, yeah, it just goes back up. But now the problem is, if we want to do this with a process like this, we could also say, okay, say we take the absolute value, then we have something that's positive, and then we also have to reflect it somewhere up here, but this is all okay. But so what happens when we get close to the boundary? And this is also something that Walter was explaining yesterday, and which you can also see from this picture that I was drawing, that if you look at a very small interval here, then this function is smooth. So this somehow doesn't change a lot. This only moves a little bit. But this Brownian motion, this moves much more. So if you only look at a little interval, this thing here can move a lot. And this thing here, yeah, this is quite small. And Brownian motion can go up. Brownian motion can go down. So when you really get close to this boundary, the drift doesn't contribute anymore, but it still goes up and down, so somehow it can always go negative. So if you want it to stay positive, what you need is not something that's coming from this drift term, but you need something additional, which in probability theory is called local time. And this is something, yeah, which corresponds to saying, okay, any finite drift that I put here, this is not enough. So I need to put, say, infinity. So when I get here, I really need a very strong drift that's pulling me back up here. But this is not very good for what we want to do here, because as I explained earlier, here the fraction of wealth that we want to hold in stocks, this should be this drift divided by the diffusion. And if this local time here, if this gives us drift infinity, we would like to hold infinitely many stocks. And if we have to pay transaction costs, this is not a good idea. So this construction, yeah, could give us a process like this, but it won't work for the context that we're dealing with here. So we need to come up with something different. So the second approach is to say, okay, yeah, when we get close to the boundary, yeah, this is too big compared to this. So what else can we do? So before we try to make this one here very, very big. So alternatively, we can say, okay, we make this diffusion coefficient very small. Because if this thing is too big compared to this, but we let this go to 0, and this happens at the right rate, yeah, then this might work. So this is this idea to say, okay, when we get close to the boundary, so really this absolute value, this fluctuates the same. Doesn't matter if I'm in the middle or if I'm close to the boundary. But now we want to look at a process which here it fluctuates a lot, but when we get close to the boundary, it fluctuates less. And now if we have a positive drift that's pushing it in, then this can stay positive. And processes like this, for example, you also use, if you want to model positive quantities, for example, interest rates or inflation rates or something like this, where you use the same idea that this factor that I have in front of the Brownian motion, this goes to 0 as this process R goes to 0. And then somehow this can stay positive. Okay, so this is our guess, that this is a good choice for the process. And yeah, now we have to try to do the computations and determine if this works or not. But really, this is a guess. This can work, this can fail, and this is what we'll see, yeah, that we're lucky and it works. Okay, so this is the ansatz that we make. So we say, okay, this is such a nice process, has a drift, has a Brownian motion part, and this means that also our shadow price process will also be of this form. So this S tilde, this was just S times exponential of this, and now you do the stochastic calculus, which says, okay, yeah, this is again of this form, and you can compute these both of these coefficients. It's not really so important. Okay, and so now we're in this nice situation that the theory without transaction costs, this tells us what the solution looks like. This is the slides I had already a couple of times. You consume a constant fraction of your wealth. You invest this drift divided by the squared diffusion coefficient. And the problem just is that I don't know these yet. So these somehow depend on this ansatz that I made for the process C. So this is still unknown. This is still unknown. Yeah, and also this. Yeah, this is somehow already known. So now, yeah, if you could do in principle everything with this thing. So you need 2 more conditions for these 2 functions. But now it turns out, yeah, these are horrible calculations. And if you want to make it a little bit easier, it's smarter that you don't use this pi, but instead you use such a transformation here. So this f of ct, which is defined like this.